Stock showed a very familiar pattern today, very similar to what we saw on last Monday, right? We started the day down, we went lower to the point where everybody thought the world was going to end, and late morning, the markets were tanking, things were super bearish, and then we got our 2% today, a 2.3% rally intraday. Again, almost a picture perfect. In fact, we've seen it a few times now in the last few days as we are this far below moving averages. So you could put it in the file of least surprising moves that we could see as we talked about this exact kind of move in Friday's video, because this is what happens. You get big moves to the downside, especially when you are already this far below moving averages. They will be followed up by big moves to the nearly equivalent size moves to the upside. And while we didn't get that from the open, we did get that from the low. And I very well expect that we'll continue it tomorrow, at least into the FOMC. Maybe not tomorrow, but especially after the FOMC, as I expect it will be bullish this week. Now, I don't expect that we'll be bullish like going forward. I still think we're in a bearish trend, this bearish pullback or bearish correction that's hardly over with at all. In fact, it's barely starting. But there's going to be plenty of up moves during this correction. So don't think that any day that they bring Tom Lee on CNBC that the low is in, right? Because that's going to hardly. In fact, it suckered in Jim Cramer at the end of March on that little intermediate rally. You know, the idea was the bear market's over with. The reality is the bear market hasn't started because the correction hasn't started yet. By then it hadn't started. It's barely started now. So we're not going to get suckered in like some of those TV personalities are, because we understand the ups and downs involved in bullish and especially even more so bearish markets. So I'm going to break that down in today's video, what kind of drove today's bullishness, some very interesting patterns in the other asset classes. And then our trade idea is a stock that's just kind of starting its own new leg lower to the downside in this particular sector especially. So let's go ahead and get started. Today is Monday, May the 2nd, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished today on a high note. Long lower shadow again, very similar to what we saw, what was that, last Monday? Very, very similar pattern. We gapped down. This one we gapped down just barely, but we went down early. We rallied late. We rallied late again, about 2.3%. What did I say on Friday? Expect that we'll get a 2 to 3% move as quick as Monday or Tuesday of this week. And while we didn't get it from the open, we got it pretty much right after the open. So pretty decent move there. So as a result, we ended up just a little bit under the low point there that started this intermediate run, that 100% level, but still back above the 224 low point. Remember that, not really a long lower shadow unless you're counting the futures contract in those days, got a really long lower shadow. But closing back up above that, so we're kind of in this area. I still think we'll get probably up into this 42.75 area, plus or minus 10 points or so. Back up to these Fibonacci lines, 78.23, those lines right there, before we ultimately break. But we are still below the 23% retracement. That's 2 days in a row now. We had a 2-day streak right there, which was our longest. We had a 0-day streak there. We just opened up and then finished above it. We had a 1-day streak 2 times, and then now we have had 2 2-day streaks, and we'll see if this one turns into anything more than that. Short-term sentiment still down here in the lower end. Again, still one big long near-term drop, as the near-term line never did get into bullish territory there. We're still 6% below the 30-day moving average, which is still in the lowest 10th percentile, which ultimately means we're most likely going to make a run up to the 30-day moving average, or at least it's going to make a run. The 30-day moving average will make a run down to where we're at right now. If you look at the NASDAQ 100, again, intermediate line. A lot of these were showing clusters today at the lows, but the intermediate line still very bearish, below the 10th percentile. So is the SPX, right? It's rare to get the intermediate line. The intermediate line finished just barely above the 10th percentile. It's really rare to get it this far down, below the 10th percentile specifically. The NASDAQ is down there, the Russell is down there. So that generally means you're going to get a decent move to the upside. Now, I don't think the intermediate line will make a run up to extreme bullish levels. It probably won't even make a run up to the bullish territory, but it will most likely run up above 20, like we saw over there before making a move back down, maybe even up out of bearish territory before making a new leg lower. That would be expected. I don't think it'll be that much of a bullish move, but certainly getting up into this upper half of bearish territory, something like this, before a new leg lower would be very, very likely. You can see we're also still very below that really important 38% retracement level, which is also the low point from 224 on the Russell. If you look at the NASDAQ 100, same thing. We are actually back above the 38% retracement and back up above the 314 low that started this intermediate run, and flirting with getting back up above the 224 low point. So again, I expect all of these to make a little bit more of a run to the upside towards these moving averages, specifically a 30-day moving average, get it up to closer to zero down here at the bottom, and then we'll get our new leg to the downside after that. And I don't think the next leg to the downside will get this far below the moving average as we saw on this run, right? You never did get back down to 10% below on any of these successive drops. That's kind of what I'm expecting us to see here. If you take a look at the weekly chart, obviously we're only one day into the week, but it's another really strong bearish candle. But this is about as strong as they get, and at least that's what we've seen, without going crazy like it did in the with COVID. But you can see all these other typical declines. This is about as big as these bearish candles get, maybe a little bit bigger on the credit downgrade, but it's really COVID or the washout move of a bear market when these candles get bigger than this. So I don't expect that we'll get any bigger. I expect that we'll probably close this week above last week's low and start to get smaller candles, maybe even a transition candle next week. Obviously, we have a death cross environment that's just barely starting. The PPO is just barely getting below zero here. Has probably more room to go down to about 3% or more based on the other corrections that we've seen. The NASDAQ 100 looks very similar. You can see it's getting down to about 4.5% now. But if you look at, again, nearly not as bearish of a candle as what we've seen, and more than likely not going to close below that low point. And you can see the Russell 2000, the same thing. It's not closing below. It's a bearish candle, but not closing below last week's low, kind of null, especially with how big the candle sizes are, suggests that you'll start to get smaller bearish candles in the upcoming weeks. Let's look at the 3 green arrow charts. Pink shading still across the board, so your stochastics is probably going to give you a green arrow first, but they're all in strong bearish levels. The MACD is rising in all of them. You can see we don't have a red bar at any of these MACDs, so the histogram is rising, we just don't have the green arrow yet, which means that the MACD itself hasn't crossed up above its moving average. Though it is pretty bearish. We're in the lowest percent. The MACD itself, the 817 gap, is about as low as we've seen this year. It's about as low as we got over there. Obviously, the difference being now is over here, you're just, all these moving averages were above the 200-day moving average. Now they're all below it, right? Every single one of these, including the 50-day moving average, are all below the 200-day. So, just again, expect to move up to these short-term averages, especially like the 8 and 17-day moving averages. That's very, very typical. You can see the Qs are below the value area for the 1-year chart. You saw SPY was too, below the value area for the 1-year chart. And then IWM has been below the value area for the 1-year chart. Getting on either side of these is either really bullish or really bearish. And obviously in this case, we're in death cross environment, so it's pretty bearish right now. Looking at the Ichimoku trend cloud, I mean, that's how close you are to a mature trend. You're above 80, but you're not quite below -5, but you're almost there. So very, very close to a mature trend on the Qs as well as on the IWM. They're all above 80 on the trend noise balance and getting to the -5 level on the trend quality indicator, all well below the cloud, all well below the green and blue lines, every one of them. So very strong trends from that perspective. Looking at the DMI, above 30, below 20, ADX is rising on SPY. Same thing with the Qs, so the ADX is already above 25. The Qs, you don't have such a strong negative indicators. It's at 29 right now, not at 30. And then of course, same thing with IWMs at 28. But the positive is well below 20, which means you have a rising ADX line there. All right, so let's take a look now at the intraday moves, and you can see the rally. I mean, again, it's about a 2.3% rally off that low into the close, getting up above yesterday's or Friday's low, getting above last week's low. So good good. I mean, lower high, lower low, but the fact that we closed back above these lows is really important and nullifies a lot of that bearishness there. Same thing with the Qs. Same thing with IWM, no gaps, you know, whatever gaps we had, we filled in. So, and we don't have a runaway gap, so I wouldn't say that this is the low point, that we've had a runaway gap and we're taking off now, or even a breakaway gap, and we're taking off to the upside. So that's not the case. You know, we're still easily in the low end of the 4-week range, way down here in the lower end. The Arun indicator, if you take a look at that, the negative is still, like, we're getting new lows, so which means the negative indicator is still at 100. Like, you're not going to set a low point until that red line starts to drop, right? And you stop getting new 4 weeks lows, and then the green line, you know, hits. Now the green line's already hit 0, so the 4-week high is already on the far end of the 20-day cycle, but you got to get that red line to stop being at 100 before we actually set a low point there. If you look at the volume and trading range today, let's see here, no, sorry, it's right here. We had 158 million shares trading hands. We had a range of 10 points. Neither one of those are super extreme. 157 is off the charts, so that's a little bit stronger than normal, but 10 points is not really that far off the charts. So again, this is not kind of one of those washout moves. When you look at the VIX, you can see the VIX actually dropped back below 100%. So again, the VIX is not getting above 100%. When it is, it's just barely, and it comes right back down. So we are just not getting washout, big range, big volume, big volatility moves to the upside that would suggest, you know, man, we are setting a low point right now because we're how extreme we are. We're just kind of grinding to the downside, which is not very common, but that's what we're getting right now. We're just trending up. There's up days and there's down days, and there's going to be more up days, right? You can see, you know, we only had a small green bar here, but remember we gapped down and then had that green bar. So we actually had a really, really strong move intraday, like I said, well over 2%. So expect probably tomorrow, if not Wednesday, to get a green bar above 2%. With a loss below 3, I fully expect that we'll get up in that 2 to 3% range. You know, just to kind of give you an idea, give me 1 second here. To kind of give you an idea of where we are relative to the 8-day moving average right now, we are currently almost 2% below that. So that's how big of a move it would take to get to the 8-day, to get to the 17-day, which is pretty, I mean, that's the likely move. It's still a 3.7% move, 3.7.5% to get to the 17-day. Now that's today. The 17 day is going to be falling. So again, a 2 to 3% move to the upside the next day or two will get us to that 17-day moving average. Then of course it's a matter of what we'll do there. Right, we might go just a little bit higher, you know, smaller ranges, especially as you head into FOMC on Wednesday. But I wouldn't be surprised. It might be after the FOMC comes out on Wednesday that you finally get it. But that's the kind of move I'm expecting us to get at some point in time this week. Like I said, I think this week will be probably a bullish week by the time we're done because of, how much we've been bearish over the last 4 weeks in a row, which is uncommon even during these past corrections. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked the video today, and it also tells us you want us to do another video again tomorrow. Quick way to let us know you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things on the right. Click on this link right here. It takes you to our Market Outlook live page. Here's where I do every Monday, Wednesday, and Friday at 3:30 Eastern Time. I do a live video here on this page, a quick 10-15 minute video. I look at trades that we've already done in prior Market Outlook videos to see whether we should stay in them or get out of them and why and how. We also already placed today's trade idea that you hear at the end of the video. We already put it on before the market closed today, so we put that on there. Check that out. You can see all the archives below there. You can also get to it by clicking on Market Outlook Live Trade Review in our main menu. Come down here, you can see our upcoming classes. Click on View More, you can see our full calendar, all of our upcoming classes, and you can go back and see 4 years worth of recordings. Just go back month to month. You can see all our recordings going all the way back to 2018. So that's how you can also get to that by clicking on Trading Rooms. You can see our most popular post right now is our registration. This is where you register for all of May's classes all in one fell swoop there for all of our premium subscribers. So you can tell when we put the new calendar out because that's one of our most popular posts. Come down here, click on the heart, takes you to this tab, hit that like button. Same thing here, click the thumbs up icon, takes you to this tab, and hit that like button as well. Excuse me, it's down here. Hit that like button. Again, the more you do that, the more people will see our content. Because of the engagements, right? The more engagements, likes, comments, shares, the more people will see it, based on how their algorithms work. It's also more likely you will see it because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at what's driving this price action. You can see how the day started. Interestingly enough, there's two. These are not two asset classes that commonly move together, but commodities and the dollar started the day strong. Early, it was equity, IWM, QQQ, SPY, US equities really started strong. They fell at their lows of the day. They were still outpacing gold and bonds and real estate for that matter. These are all kind of safer asset classes, all really lagging behind today. But again, the dollar is typically a safety trade too. And it's not dropping, right, with how far bonds and gold are going. So commodities are continuing to move. Again, this is not your typical bullish dollar trade to see. And not surprising to see gold down there, but it's to see kind of, the dollar's so strong and equities end up being so strong and commodities with weakness in bonds. That's not very typical. Not very typical at all. Let's take a look at some of their charts. Let's take a look at TLT first. Bear with me 1 second to bring that up here. And you notice the divergence it's forming, right? The MACD is forming, and at least right now is at least a higher low point. It's a very, very low MACD. That initial low point, of course, stochastics too. They're both flirting with their moving averages. You're already at lower lows on TLT itself, so it's kind of it's trying to figure out some kind of divergent low point here. You can see the same thing with the negative indicator and the positive. Negative indicator back above 40, but unless it really goes haywire, is going to end up forming a lower high point. The positive indicator is going to end up forming a higher low point down there at the bottom. So you're definitely in divergent mode. You look at the RSI and the CCI, the same thing. The CCI is at extreme lows again. The RSI back below 30. but still it would be a higher low point than what you have previously. The low point you had previously down there at what would that be, at 23. At that particular low point. Let's take a look at the dollar. And then there's the strength in the dollar, really staying parabolic here on the RSI, well up above 70, which is rare for the dollar to be so bullish. It's positive indicator up above 50, negative is well below 20, not quite below 10, but at least well below 20. The ADX for UUP of all things has gotten above 40, and again we know why, right? We know that that's a function of, well, here, let me show it to you this way. We'll look at the currency chart, comparison chart here. And then you can see, just looking at today alone, there we go, that the dollar, the yen was actually pretty strong today. The yen outperformed the dollar despite the dollar's weakness. The strength in the dollar came against the European currencies, pretty much all the European currencies, whereas all your commodity-related currencies outpaced the greenback, right? They caught the Aussie, the Kiwi, the yen. They're all up there at the top. The Canadian dollar lagging behind, but not by very much, right? Same thing with the euro there. So very interesting pattern across some of these different asset classes. So what TLT looks like relative to these moving averages. Remember, we're way below the 200-day moving average, like probably as far below as we've ever seen, and way below the weekly, the 200-week moving average, right? This thing is in bear market mode and is at an extreme. You can see other asset classes on the risk appetite scale. On the other end of the scale than TLT, Bitcoin, you can see it's trying to figure out what it wants to do. Is it going to make its way into finish this correction mode, or are we going to stay in pullback? And I think you're going to have to get below this point of control in that 50% area if this is indeed going to turn into more of a correction. Right, and of course, looking at commodities, it's really gone parabolic too. It's on a very strong trend. That trend has been converging. If you look at, we are above the 17-day moving average, but the MACD is below its moving average and has been. So we are in a convergence mode on the stock as we head towards the 30 and the 50. But that gap between the 50 and the 200, again, one of the bigger gaps that we've seen, including the 200, the 2014 and especially 2008 time frame when it got really bullish, right? When we were in, here, let's go to a weekly chart. There we go. Back in 2008, it got up to this 26% level, and that's about where we're at right now. So very strong move as we pull away, as the price pulls away from the 200 and pulls away from the 50, right? If I were to go here and change this to the 50. Then you can see where it's at there on how far up above the weekly chart we are, 25%. You can see it's about as far as we got over here, up to 30%. When we were in the beginnings of a bear market, we had the correction early in that year, a good rally in commodities, and then a rally again as we got the correction bounce that ultimately failed, and it turned into a bear market. And then remember, in a bear market, everything drops, including commodities. All right, so for our trade of the other day, I want to take a look at Medtronics. Medtronics had been bullish for longer than a lot of these stocks. Got a cluster, got the light pink shading and a red line in this case, and then you rallied for just a little bit longer, and just you was trying to hold on before finally giving in here. About a week ago, last week, and then by the end of the week, turning into dark pink shading and a red line, and today as well. The intermediate line going from being in bullish territory, upper reversal zone, staying in bullish territory, but then finally breaking below the market sentiment line, and then breaking into bearish territory, nearly practically the lower reversal zone, well below the moving average down there. You can see It had gotten, during the rally, it had gotten back up to the 40-week moving average before getting a couple transition candles and then a couple more now bearish, pretty strong bearish candles there, and we're back to the downside. From a 3 green arrow perspective, if you take a look, at, here you're obviously again, there's your intermediate run, you're above all these moving averages. You finally broke on the 22nd, the 17 and the 30 and the 8 for that matter, all at the same time. Made one, got to the 50, held the 50, kind of traded in the gap, and then finally broke the 50 before breaking down Friday, and then now continuing down below the point of control today. Your 8 and 17 day crossing below the 30. Now they're both crossing below the 50. You can see when you get those two lines across the 30 and then the 50, you can start bearish runs for a while. Same thing when they cross back above those lines, like over here. So we're just crossing below the 50 after just crossing below the 30, and you're crossing below the point of control. We have an opportunity for this flag pattern to turn into another bearish leg lower below the 50-day moving average. And you can see on a longer term level, you're breaking below the 200 week, right? So you got to the 200 week, you got your correction. This right now is your failed correction bounce. And what we may be starting its own bear market right now with the MACD rolling back down below its moving average. So this is what a bear market looks like. So when we look at from a broad market perspective, remember we're still way up here. We haven't touched the 200 week, but Medtronics has touched the 200 week and then bounced to the 30 or the 50, in this case the 30, failed. There's your failure, your correction failure. Because that bear market, every bear market will start with a correction, and just about everyone will start with a correction bounce. Right? So you get a correction bounce that fails, and then after the failure, you make your way back down below the 200 to the point where now all these other lines will start coming down. That's the idea, and you'll make your way probably down towards 86 by the time all is said and done on this. When you look at some of these indicators, some of these other oscillators, you can see above 30, above 35 on the negative, below 15 on the positive. So, and the ADX is well below 20, so it's just barely starting a trend-ready state, or it's in a trend-ready state, breaking out here. From an Ichimoku cloud, you're back below the cloud on the last couple of days. You're starting a new intermediate strength trend, down at the bottom there. Your RSI and CCI are also showing bearish patterns, getting back to bearish levels. And then from a Bollinger Band perspective, we are back into the lower quartile, pushing down with a rising band width. So you have the opportunity. In fact, if you look at the Bollinger Bands, they just barely crossed back outside of the Keltner channels. If you take a zoom in on those Keltner channels, we closed below the lower channel today, but not quite below the band. So whatever skinny little gap there is between the Keltner channel and the Bollinger Band, you are trading inside of that, which is bearish, right? Especially with the green dots and the increasing bearish momentum. It's looking like we're moving to the downside with the bandwidth rising. The bandwidth is rising towards a recent high, but you can see it's been higher than this on stronger bearish runs that we might be headed towards. So there's opportunity for bearishness. So what we decided to do here was to sell a bear call spread, sell the 105, buy the 110. Again, this is what it looks like with a full position size. That break even, as you can see, is right there. That's going to be above here. Let's just take a look at that break even with the Bollinger Bands. It's going to be above the last couple of days lows, back above this point of control and above this volume node. And you can see pretty much it would get back above this last couple of days where we really broke down. So you'd have to get back above today's and Friday's high point, essentially the midpoint of the 4-week range, before you would take a loss, right? Before we close the trade. And you remember, we're trying to make 534 bucks. So I'm position size for a full, normal position, $1,000 of risk, but I'm really only willing to lose 534. I'd close the trade if and when we got to that point, if we did get back up. So, it would take a significant move, a significant reversal, not just a little reversal like this. That's a nothing reversal. This is why we did a bear call spread, so that we can do even more of that and still be okay before staying down below, what would be the 105 strike, which would be right into this area. As long as we stayed below this level, then you'd be fine. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. You can also subscribe to us at marketscholars.com. Like us on Facebook and Twitter. Have a great rest of your Monday night, everybody, and we'll see you all next time.